It's January 2020. You've worked hard, you've been responsible, and you've managed to save $100,000. You put it in a savings account. You feel good about it. You feel safe. You tell yourself, I'm being smart. I'm not gambling with my money. It's right there when I need it. Fast forward to today, 2026. That same account still says $100,000. Maybe $105,000 if you earned a little interest. But here's what nobody told you, that $100,000 no longer buys what $100,000 used to buy. In real purchasing power, after everything that happened with inflation between 2020 and today, you've lost somewhere between 20 and 28 cents on every dollar. You didn't lose it in a crash. Nobody stole it. It just quietly evaporated, eroded by a force most people never learned to defend against. That force is inflation. And it is the single greatest threat to the wealth of ordinary people in 2026. But here's what's even more disturbing. The conditions that cause that level of wealth destruction, the money printing, the government spending, the political pressure on central banks, none of that has gone away. In fact, in many ways, it's gotten worse. And if you don't have a real plan to protect your purchasing power, you're going to keep losing ground. Every year. Silently. Without ever seeing it happen in your bank statement. That is what this video is about. Not hype. Not get rich quick. This is a serious, practical breakdown of how the economic system actually works in 2026, why your money is at risk, and exactly what you can do about it, step by step, decision by decision. By the end of this video, you're going to have a complete framework. A real plan. One that you can start implementing today, regardless of how much money you currently have. So let's start from the very beginning. Because to protect your money, you first need to understand what's attacking it. Most people think they understand inflation. Prices go up, things get more expensive, that's inflation. And yes, that's part of it. But that's a surface level understanding, and surface level understanding leads to surface level protection, which is not enough in today's economy. Inflation is not just about prices going up. At its core, inflation is about the purchasing power of your money going down. The price of a house didn't go up because houses became more valuable. The price of a house went up because the dollar became less valuable. That's a critical distinction. Because if you think the problem is that things cost more, you'll look for ways to earn more. But if you understand that the problem is that your currency is losing value, you'll look for ways to hold a different kind of wealth, assets. Now let's talk about where inflation comes from. The dominant cause is monetary expansion. When a government or central bank increases the supply of money in the economy without a corresponding increase in goods and services, you get inflation. More money chasing the same amount of stuff means each unit of money is worth a little less. Let me give you some numbers. In 2008, the total money supply was about $8 trillion. By 2020, it had grown to about $15 trillion. And then, in just 2 years, 2020 and 2021, it shot up to nearly $22 trillion. The United States printed more money in those 2 years than it had in its entire previous history combined. And you wonder why inflation hit 9%? It's not a mystery. It's math. Here's the part that really should make you angry. When the government prints money and spends it, the first people to receive it, big institutions, government contractors, banks, they get to spend it before prices have fully adjusted. They buy assets. They buy real estate. They buy stocks. By the time that money trickles down to ordinary wage earners, prices have already gone up. Your paycheck buys less. Your savings buy less. But the assets owned by the people who receive the money first? Those went up in value. This is why inflation is not just an economic phenomenon. It is a wealth transfer mechanism. It transfers purchasing power from people who hold cash and earn wages to people who hold assets. And understanding that is the first step to getting on the right side of that equation. Here's a fact that should stop you in your tracks. In the early 1970s, the typical American household was supported by one income. And on that single income, a family could afford a house, a car, healthcare, to send kids to college, and still save for retirement. One income. One worker. Today, the typical household requires two incomes just to maintain a comparable standard of living. And even with both partners working full-time, many families are still struggling. Since 1970, median household income has increased roughly 6 times. But the cost of a car has gone up 8 times. The median home price has gone up 12 times. College tuition has gone up 20 times. And remember, that income increase went from one earner to two. Per worker purchasing power has barely moved in 50 years. The bottom line, inflation is real, it's persistent, it's structural, and it hits hardest the people who don't own assets. Which is most people. And that's exactly what we're going to fix right now. Now we get to the core of this video. Your wealth protection framework. 5 pillars. Each one is critical. And together, they create a system that works in good economic times and in bad ones. Pillar 1, your income and your business. The single most important financial asset you own is your ability to generate income. And the most important thing you can do to protect your financial future is to protect and grow that income. In 2026, the labor market is being reshaped by artificial intelligence at a pace that would have seemed like science fiction 10 years ago. Entire categories of work, data entry, basic analysis, routine customer service, are being performed by AI tools that are faster, cheaper, and available 24 hours a day. The skills that are hardest to automate, complex problem solving, leadership, sales, creative strategy, these are becoming more valuable, not less. Invest in your skills. Find mentors. Get experience in areas with high demand and low automation risk. And if you have a business, or you're thinking about starting one, your business is your most important investment. Not your stock portfolio. Not your real estate. Your business. Because a well-run business generates active cash flow, builds equity that compounds over time, and can be sold someday for a multiple of its earnings. Invest in your business like you'd invest in any other asset. Reinvest profits. Build systems. Market consistently. Pillar 2, real estate. Real estate has created more millionaires than any other asset class in history. And in 2026, despite elevated interest rates, it remains one of the most powerful tools available for building and protecting wealth. Here's why real estate works as a hedge against inflation. When you own property, property values tend to rise with inflation, often faster. Rents rise with inflation, increasing your cash flow. And if you finance the purchase with a fixed-rate mortgage, your biggest monthly expense stays constant while everything around it gets more expensive. You're paying back the bank with inflating dollars while receiving rising rent from tenants. That's a powerful economic position to be in. Yes, mortgage rates are higher in 2026 than they were a few years ago. But the United States has a structural shortage of housing that has built up over years. That demand doesn't disappear because rates are high. It means rental demand remains strong, which benefits those who already own rental properties. If you're not in a position to buy physical real estate right now, there are other ways to get exposure. Real estate investment trusts, or REITs, trade on the stock market and represent ownership in portfolios of properties. They're required by law to distribute at least 90% of their taxable income to shareholders as dividends. If you can afford to buy a home, buy a home. The forced savings of paying down a mortgage combined with the inflation hedging properties of real estate make it one of the best long-term financial decisions available. Pillar 3, stocks and index funds. The stock market is the most accessible wealth building tool in existence. With $50 or $500 a month, you can own a fractional piece of the most successful companies in the world. And over long periods of time, 10, 20, 30 years, the stock market has been the most reliable generator of wealth available to ordinary investors. The key is to stop speculating and start investing. An S&P 500 index fund gives you ownership in the 500 largest publicly traded companies in the United States. You're not betting on any one company. You're betting on American capitalism as a whole. Over the past century, the S&P 500 has returned an average of approximately 10% per year, through 2 world wars, the Great Depression, multiple recessions, a global pandemic, and everything in between. The strategy is called dollar cost averaging. You invest a fixed amount on a regular schedule, every paycheck, every month, regardless of what the market is doing. When markets are down, your investment buys more shares at a lower price. When markets are up, your existing shares are worth more. Over time, it all averages out in your favor. This strategy is boring. That's the point. Boring, consistent, disciplined investing beats exciting, emotional, reactive investing almost every time. Time in the market beats time in the market. Every single time. Pillar 4, Gold and Hard Assets. Gold has been a store of value for thousands of years. An ounce of gold in ancient Rome could purchase a high-quality toga and sandals. An ounce of gold today can purchase a high-quality suit. The dollar figure changes. The purchasing power doesn't. Over thousands of years, gold has maintained its value in a way that no fiat currency has ever managed. Gold performs best when inflation is high, when the dollar is weakening, when confidence in governments and central banks is low, when geopolitical uncertainty is elevated. That's essentially a description of the environment we've been living in since 2020. Central banks around the world, particularly BRICS nations, have been buying gold at record rates, reducing their dependence on the US dollar. That trend supports the case for gold. Gold is not a growth investment. It doesn't pay dividends. It doesn't generate cash flow. It's insurance. It's a store of value. Keep between 2% and 5% of your portfolio in gold, physical gold or gold ETFs, as protection against serious monetary disorder. Pillar 5, Financial Education. No investment strategy, no asset allocation, no financial framework will protect you if you don't understand what you're doing and why. Financial illiteracy is extraordinarily expensive. And in 2026, the cost of not understanding how money works is higher than it has ever been. Financial education gives you the ability to see through bad advice. There is a massive industry built around selling ordinary people financial products that benefit the seller far more than the buyer. High-fee mutual funds. Whole life insurance sold as an investment. Annuities with crushing surrender charges. Timeshares. Cryptocurrency schemes. The people who fall for these products aren't stupid. They're just uninformed. Financial education is the armor that protects you from financial predators. It also gives you the ability to take advantage of opportunities most people miss. Retirement accounts, 401k plans, IRAs, SEP IRAs, offer tax advantages that can be worth hundreds of thousands of dollars over a lifetime. People who understand these tools use them. People who don't leave that money on the table. And perhaps most importantly, financial education means understanding your own psychology. Human beings are wired to make terrible financial decisions under stress. We panic when prices fall. We chase performance when prices rise. The investors who build real wealth are not the ones who made the best predictions. They're the ones who built the best systems and had the discipline to follow them even when it was uncomfortable. Invest in your financial education. It is the highest return investment available to you. And unlike every other investment in this video, it cannot be taken from you. Now let's talk about what not to do, because avoiding the biggest mistakes is just as important as following the right strategies. Mistake number 1, holding too much cash for too long. Cash is not safe. Cash sitting in a regular savings account in an inflationary environment is a guaranteed loss of purchasing power. Your emergency fund belongs in cash. Everything beyond that should be working for you in assets that appreciate. Mistake number 2, trying to time the market. I'll invest when things calm down. I'll wait until after the election. These sentences have cost ordinary investors an incalculable amount of wealth. The best returns often happen in periods of maximum fear and uncertainty, exactly when most people are on the sidelines. Invest consistently, regardless of conditions. Period. Mistake number 3, letting lifestyle inflation consume your income growth. You get a raise. You upgrade your car. You move to a bigger apartment. 2 years later, you're making 20% more but saving the same amount. Wealth is not about how much you make. It's about how much you keep and put to work. Mistake number 4, not starting. Every year you wait to start investing is a year of compound growth you never get back. If you invest $500 per month starting at age 25, earning an average 8% annual return, you'll have approximately $1.75 million by age 65. If you start at 35, you'll have about $745,000. Waiting 10 years cost you over $1 million. The best time to start was yesterday. The second best time is today. Let's bring this together into a concrete action plan you can start implementing right now. Step 1. Get an honest picture of where you are. What is your total monthly income? What are your total monthly expenses? What do you own? What do you owe? Your net worth is assets minus liabilities. Write it down. That discomfort you feel looking at the number is information. It tells you exactly how far you have to go. Step 2. Build your emergency fund. 3 to 6 months of living expenses in a high-yield savings account. Liquid, accessible, earning something. Without this, any unexpected expense will force you into bad financial decisions. Step 3. Eliminate high-interest debt. Any debt above 8 to 10% annual interest, pay it off aggressively before you invest in anything else. The guaranteed return of paying off 20% credit card debt is better than any investment in the world. Step 4. Maximize your tax-advantaged accounts. Contribute to your 401k at least up to your employer match. That match is an instant 50 to 100% return on your money. Then fully fund a Roth or traditional IRA. Step 5. Build your diversified investment portfolio. Low-cost index funds. A U.S. total market fund. An international fund. Keep fees low. Automate your contributions. Do not check your portfolio every day. Step 6. Add real assets over time. Real estate, rights, a modest gold allocation of 2 to 5%. Build gradually as your income and capital grow. Step 7. Never stop learning. Read books. Watch channels that give you real, evidence-based financial information. Find mentors who are further along than you. Build your financial knowledge the same way you build your wealth, consistently, over time. Here is the final truth I want to leave you with. The economy in 2026 is complex, uncertain, and in many ways unfair. The system rewards asset owners and penalizes cash holders. Inflation punishes savers. The monetary system creates winners and losers in ways that most people never fully understand. But you are watching this video. You're seeking knowledge. You're trying to understand the game so you can play it better. And that puts you ahead of the majority of people who will go through their entire lives never understanding why they can't seem to get ahead no matter how hard they work. The strategies in this video are not secrets. They're available to anyone with the discipline to apply them. A business that grows. A home that builds equity. Index funds that compound over decades. A small position in gold as insurance. A commitment to continuous financial education. None of these require a massive starting capital. They require knowledge, patience, and consistency. You don't have to solve everything tonight. But you can take one step. Open a high-yield savings account. Start your investment account. Pay off that credit card. Read one book on personal finance. Take one action, the smallest, most concrete action you can take right now, and build from there. Your financial future is not determined by the Federal Reserve, or by who sits in the White House, or by whether the stock market goes up or down next quarter. It's determined by you. By your knowledge, your habits, and your willingness to play a long game when everyone around you is reacting to the short one. If this video gave you value, share it with someone who needs it. Leave a comment below with the one thing you're going to do differently starting today. And subscribe, because we're just getting started. I'll see you in the next one.